If I could ask you all to enter your questions now. I see there is a number coming through. So let me start. Peter Little, are you with us?
I am still here.
Yes, Peter Little, first question for you. Peter, did you see any signs of the crash in 2008?
2008. Yeah, I mean, as I said a few times in my presentation, the narrative at the time is always very compelling. It's very difficult to differentiate from a bull market and a bubble. It's obviously obvious in retrospect where we look back at the stats and say, people were potentially taking on too much home equity. But for me, there were worries, but there's always stuff to worry about, as Nick said. Like there's plenty of stuff to worry about, but if you focus on that, you'll never get anywhere. And in 2008, I was actually living in the US at the time. I was in New York. My wife had got pregnant with our son at the early part of the year. And so in July 2008, I bought a house when my wife was in I think what they call the nesting phase of pregnancy, where she was very unhappy about the apartment we were renting in Manhattan at the time. And so I joined the throngs of people who were desperate to buy Manhattan houses just before they all came crashing down after the Lehman collapse. So for me, it obviously wasn't particularly obvious at the time. I think the good thing was I eventually sold that house for more than I bought it for. So, fortunately, I wasn't forced to liquidate in 2009. But yeah, I think there's always a very compelling narrative. And you always get people who will say afterwards, oh, it was so obvious, like, the hindsight specialists will always tell you that it was clear that was a bubble at the time. And maybe they did think that at the time, and a lot of people could have, predicted that at the time. But I would say it's generally very hard to know that you're in a bubble and to figure out that you've transitioned from that phase where you're in just a regular bull market to the phase where you're in a bubble. Usually there's lots of speculative activity and leverage around, but again, that can go on for sort of 10 years before it all ends in tears. So timing your way around that stuff, I think, is a fool's errand.
So Nick, I see that there's a plethora of questions for you, so we're going to keep you on the line for a bit here. First question, do you think technology stocks will continue to rise and push markets higher in the next 5 to 10 years? And what areas do you think won't do well in the next 5 to 10 years?
So my focus tends to be really I choose stocks one by one on a bottom-up basis. They do tend to be, and so my focus is on what are called multi-baggers. That's a Peter Lynch phrase, companies and stocks that can go up 5x to 10x over the next 5 to 10 years. Quite often those are technology stocks, or companies that are enabled by technology. And I just, I've called it the second Cambrian explosion. So I just think we're seeing so much innovation, new ideas, new platforms emerging, companies being built on those new platforms that, for me, I think, so I think those technology, as it's sort of very sort of broadly termed, is going to do well over the next 5 to 10 years, and I think that will probably bring the overall market, drag the overall markets with them. Whether that's the mega caps leading the way, I think they probably do well. They're sort of FANG stocks. I'm not sure that they will lead the market in the same way that they have over the last decade. And then I think you just got to, what won't do well, I think you've got to look out for stuff that's going to be disrupted. So I think you've got to be careful in, I would say, energy. I think the world is moving towards sustainable and renewable energy sources. That is going to happen. So I think you've just got to be really careful with those companies. I think the legacy banking areas could come under pressure as sort of digital wallets and sort of fintech solutions come up. And then, I think you've really got to sort of examine the question on really almost down at the product level and say who's doing the best job of serving clients in terms of, better convenience, better features, better value add, all of that kind of thing. And so if the company, whether it's a new technology or legacy company, whoever does that better, I think that's who wins. So
Nick,
just got to be careful.
would you be buying Tesla at these prices?
Yeah, so with the massive proviso that this is not an investment device, I'm very bullish on Tesla, as you could tell by the presentation. My skill set is not sort of timing when these things are going to bottom or top. But I think Tesla's got the potential, with no guarantees, obviously, of becoming the world's largest company and world's most profitable company by a long, long way. So I'm bullish, for sure.
Peter, question for you. If the ANC weeds out corruption, as they are busy with now, what other factors remain the same? And other factors remain the same, including the dollar printing in the US. Will we see around a 5 to 6 rand weakening per annum for the next 10 years?
That's a good question. So we're saying that everything stays the same. I think obviously the one big constraint to our economy is the electricity supply. So I guess I'm assuming in that question that if corruption's weeded out, that we get Eskom back on track and we have more than enough energy to do what we want. I think if you assume that we revert to sort of a normal run rate based on emerging market characteristics, where we're growing our population pretty quickly and we're improving efficiency and the economy can grow pretty fast, I imagine that we'll get some inflation coming back. And that's ultimately going to be the biggest long-term determinant of what happens to the rand relative to the dollar. So we would assume that over the longer term, the rand will depreciate at the differential between US and South African inflation. So assume we get back to a sort of middling scenario for the local economy, and inflation is around, call it 4 or 5%, and the US does a good job of containing their inflation at less than 2%, then I think you're in for about 2 to 3% depreciation in the rand for periods of time. And obviously, short term, who knows what happens to currencies, but longer term, I wouldn't expect as much as 5 to 6% depreciation on the rand if we were running at a relatively good clip that allowed us to absorb or digest some of the debt that the government and individuals have taken on, and we're on a kind of generally improving trajectory.
Thank you. Nick, question for you. Is inflation dead? If it comes back in a meaningful way, where does the US long bond go to? And what does this do to the short-medium outlook for expensive growth stocks like Tesla, Amazon, and Netflix? Nick, you're on mute.
Okay. I think my take is I'm with the Fed. I think that inflation is transitory. If you look at, and I think we're in a really funny period because of COVID, and we've got all these bottlenecks popping up. And if you looked at the inflation basket, what's driving it? It's weird stuff like used cars, airfares, out-of-home lodging, and so there's a lot of there's a mix between sort of shorter-term stimulus and then supply-side constraints. Why I think there's not going to be, why I just don't see much inflation on a secular basis once we get through this sort of very messy period is I think in large, well-diversified, predominantly developed markets, and you can include China in there, is that the supply side works phenomenally well. So when people speak about inflation, they typically focus on the demand side. And there's reasons to believe that I think even on the demand side, it's very difficult to see a really pronounced credit cycle, which often drives the sort of demand side, given levels of global credit penetration. But on the supply side, as economies open up, these bottlenecks are going to be solved. So you've seen lumber prices initially shot up, and that was a very lumber-specific story, but the supply side is responding, and I think you'll see that everywhere. So I don't think that'll happen. And then also, I just think technology is also just making it easier to what the capitalist system, the way I think it works and the way technology works is it works to bring on incremental supply at low cost. As if you think like an Airbnb, you can add effectively 1,000 hotels like with a click of a mouse kind of thing. So, which is inherently disinflationary. And then the other thing I think is the current period is not like the sort of the 70s, because the resource intensity of economies has just gone down and down over time. So the raw material commodity impact is a lot lower. And I think it'll keep on going lower, particularly as we move towards more kind of sustainable energies and driven by companies like Tesla, and we use more solar, less kind of oil and stuff. So it's, to me, like, I'm open-minded to the idea that inflation could be higher, and particularly if I think fiscal would need to just play a pronounced and more consistent, like they'd have to ramp it up massively and just keep it there. But even then, I mean, if the fiscal goes into bringing on sort of new roads, bridges, fixing up the sort of decaying infrastructure in places like the US, if it goes into more solar infrastructure, if it goes into the supply side of the economy, I think that's disinflationary. So that's that. So I think, secular, I don't think inflation rises. Second part is, though, to the extent that the market obsesses about inflation and drives up interest rates, shorter term, clearly that's a headwind it has been a headwind to growth stocks. People rotate into value stocks, into cyclicals. But history has shown, if you look at the late 2000s, we had a bubble in the NASDAQ and growth stocks, even where the long bond was, ranging between 4.5% and 6.5%. And so people weren't put off by higher inflation and higher bonds. And in the steepest part of that run up, where the market went up, the NASDAQ went up 200% in 18 months, or whatever the number was. I think the long bond was up from 4.5% to just under 7% in 18 months. So I think the more important factor is like animal spirits and risk appetite. So, yeah, I think that this kind of current narrative is flawed, at least judging by history. And I think, the market will digest it. And I think, high growth stocks, I think they'll have their day in the sun again.
Thank you, Nick. Question for you, Peter. What is your take on the NASPERS process share swap? Pete, you're on mute.
Yeah, sorry, the NASPERS process share swap. So, there's two aspects to it. I think it's clear that the NASPERS guys are working incredibly hard to try and unlock some of that discount to the underlying investments. So they're incentivized to do that. You can bet that they have pretty much every banker in the world is throwing suggestions at them for how they should do that. They have some pretty tight constraints around exchange controls and keeping their local tax base. So they have a very complex problem to solve, and they have some very smart minds working at this. And I think this is an interesting thing. We've put out a more detailed note on it, but the gist of it is that you're issuing stocks at a lower discount to buy stocks at a higher discount, and so that's accretive to the NAV. So mathematically, it all makes good sense. I think you can increase NAV by about 6%, depending on how many people take up the offer. And so I think sort of mathematically, they're solving a problem for unlocking some of the NAV discount by just improving the NAV with this transaction. I think the challenge is that we've seen, just from a sentiment perspective, with these holding companies, that when you have things that add complexity, they generally don't bode well for unlocking discounts. So you have these two competing forces. Practically and theoretically, they've done something that will increase the NAV. And then you've also added this complication of now you have a cross-holding to kind of try and factor out, which adds complications, which will probably not do a lot for sentiment. So you have these competing forces. I think they probably net out with a slight increment to the NAV.
Pete, just to follow on from that question, NASPERS or process?
If you were going in with new money today, I would still probably go with Naspers. I think it has more discount. It sort of has more runway to unlock discount than Process. I think Process is slightly cleaner, and it has the benefit of liquidity of being on the European exchanges. But I think you have just a better scope for, like, the magnitude of the unlock is working in your favor on the Naspers side.
Last question for you, Nick. The interesting one. Would the decentralized financial system being created by a disruptor to the current financial services industry by providing services directly to clients, specifically to the younger generation, that would prepare this, which would prepare this way of financial services compared to the current system? So I think, just reading through, they're asking, does this new decentralized financial services system pose threat to the current financial services industry?
So look, it's so early days, so it's difficult to know, and I'm certainly not an expert on DeFi. But I think over time, I'm realizing it is something that I need to take more seriously. And so I think it's best to assume that I think the risk with a lot of these things, and the risk with, like, sort of Bitcoin, a year ago, 2 years ago, 5 years ago, 10 years ago, is underestimating these things and underestimating the potential for change. And so, yeah, I absolutely think that could disrupt the current status quo. But then you've got to, like, as I say, you've got to go back to first principles and say, is it offering better value to the end customer in terms of, like, price or convenience or all of those things? And I think in many cases, the answer is it probably will. So, without having a huge amount of knowledge on this, I would say my bet is I think it could well be disruptive. Yeah, so watch this space.
Guys, that does take us to 3:00. Thank you very, very much to Nick and Peter for giving of your time. We will send out a copy of the recording. Thank you very much for joining us for Essentials, and we'll see you next month for the next one. Thank you and goodbye.